Good afternoon, guys, and welcome back to another video. I'm the Friendly Investor, where I talk about stocks, upstate stocks, and try and keep you up to date with the most recent and informative information regarding stocks to make your best decisions. Just a disclaimer, I just say this for entertainment purposes only, and I urge you to do your own research and due diligence to make the most up to date and informed decisions. Right, now let's get started. This video is about how to invest your first £1,000. Now, if you already invested your money but you're still looking at some sort of trading strategies, this could be a good video for you, and I recommend watching it just to maybe give you some ideas up to date. But primarily this is for the people who have spare £1,000. Well done for having a spare £1,000. It's very hard to do, especially given these certain economic times and everyone's going through their financial hardship. So well done, that bit. Give yourself a pat on the back. Well done. And so I just want to say, if you have £1,000 spare and you're looking to invest it, and you don't really want it lying around in the bank, and you want to maximise the returns just from that money, you kind of want to make money, you just want to leave that there and make the money work for you, which is brilliant. So this video is hopefully give you some ideas on how to invest your first £1,000. Now, I just want to say, before you invest your first £1,000, I would say it's a good idea to look at some sort of trading platforms. Now, here's just a list of some trading platforms that you could use in brokerage accounts, for instance, eToro. Yeah, I'm not going to go into these, but I would say look at some trading platforms and download some. Don't sign up, just get a feel for the platform and see what one works for you. Now let's get on with the video. I just want to say, before I start, the idea of this video is for the first £1,000, it should be in my opinion, an 80% into ETFs and index funds where you can get some sort of return on. You can get where they're having a decent average annual growth rate and you're getting some sort of dividend yield. Now, a brilliant one, I just want to say before I start that, if we look at the largest stock market, this is really good before you make your decision, and you can see where most of the stocks worldwide are in terms of worldwide value in the market share. Now, if we look at the US, they have just under 55% of stock markets worldwide as of January 20. So now this is quite an outdated source, but it's still very relevant, and I doubt this would have changed much. In fact, it wouldn't have, because US, these stocks this would kind of be very similar year in year out at the moment. But if we look at US, just under 55% of stock markets worldwide, that's the value they own. Well, most of the stocks are in fact the US. So this is very appealing in my eyes, as if you're looking to invest it, you should look at an ETF that invests into most of these companies. Now, a great one is the S&P 500. Now, what is the S&P 500? That is the US is an American stock market, is the benchmark of American stock market performance dating back to the 1920s. Now, what is the average annual growth rate? It's around 10%, and the dividend yield of this is between 2 to 5%. Which is brilliant. So if you invest in that, so for instance, your first 80%, you're going to be receiving around 10%. Obviously, year in, year out, sometimes it may be negative, sometimes it may be positive, because that's where they get the average from. But if we look at the S&P market summary, and I'll just get over 5 years, we can see it's had a very steady incline with a sharp decline. Obviously, this would have been the coronavirus that has affected them, with that big dip where everyone sold off and the economy isn't doing great because they had to go into lockdown. And then we can see that sharp increase where the economy starts to pick up again, and we're seeing that steady slope increasing upwards. Very positive. Now, I just want to say that the S&P 500 will be investing in the 500 largest companies listed on the stock exchange in the United States. So when you think about it, you've got Amazon, you've got Microsoft, you've got really large companies that will be involved in the S&P. These companies will also be driving this S&P 500 because they'll be invested in it. So when you're investing in the S&P 500, you're betting that country is going to be exceeding and is going to be increasing in growth and size of its large companies and orders around the world. And the S&P, you may or may not be aware, the US have a large amount of dominant players. For instance, you have Elon Musk with Tesla, SpaceX. You have Amazon. You've got Microsoft, you've got really huge companies and really dominant players that are very well known worldwide which is why the S&P 500 is doing brilliantly. And I'll just take a look for your own research. I recommend looking at the stocks and see what companies are in there, as it could help you make other decisions about what stocks you'd like to invest in regarding growth stocks, which I'll get onto in a little bit later in this video. So yeah, the market summary over the S&P 500 is just very good. It's very strong growth rate, and is over the course of since 1981. This has actually been around since 1928, but since 1981, it's been out since. Yeah, look, we can just see that's very, very slow. But if you think about it, well, that may feel quite slow. It's actually a very rapid incline. This is very good, year in, year out, 10% growth rate. This is quite hard to achieve as well. Not many hedge funds are able to beat this. This is why the S&P 500 tends to outperform most trading platforms. That's why if you were to looking at invest, you don't really want to pay attention. Just chuck it in there and check back every now and then, but also pay attention to the economy and see the driving forces behind this, because the stock market isn't its own currency. It is affected by how well the companies do in that country, for instance. But I just want to go back to this, and for instance, if you don't want to invest in the US, you don't have to. There are plenty of dividends that do a worldwide dividend, which would invest in a portion of the US, Japan stocks, UK stocks, Chinese stocks, French stocks, all those kind of stocks, and you get a very large spread, which would minimize the risk. But obviously, the greater the risk, the greater the reward, and the larger you spread your eggs, although that is very good because you could still get some returns, the reward is not going to be as great as if you were investing in the single S&P 500, where you can see that 10% average annual growth rate plus the 2 to 5% dividend yield. Very positive returns in the long run over 30-40 years. It is understandably why it is recommended. For a lot of financial advisors would say invest into this, but just remember to do your own research and get a flavour for what you are passionate about within the industry. For instance, see what things you're purchasing and what things you're interested in. Find that industry and that you can specialise in and really understand to make the best decisions in that industry. Now, I just want to say the next 15%, I would say investing in REITs. Now, what is an REIT? Let's get this up. It's a real estate investment trust. And what this does is, so for instance, say if you're interested in going into real estate, but you don't own any property, that's fine. These are really good for you, because what they do is you be investing in companies that will own a large amount of properties, or just a couple, but they'll be owning very much property, and you'll be receiving dividend yield from this. Now, I'd say that a lot of REIT companies, you see in the right here, you've got Digital Realty, American Tower, Prologis, Equinix, Crown Castle. These are all very good companies, but I recommend doing your own research, as these are very similar to ETFs, but they have very long-term total returns, and they tend to be very similar and more than the lower risk bonds. But it's also a very good idea to invest your 15% just to get a mix and spread your eggs a little bit. And I recommend they do tend to have about a 3 to 10% dividend yield, with the annual growth rate is quite undetermined, but it's just something to get your eyes into, but you don't have to. If you're really happy with ETFs, stick to them. Stick to what you know and stick to what you feel comfortable with, because that's the main thing at the end of the day. Although you may want to maximize your money, if you're unsure or have that gut feeling, I recommend just staying away and just keep doing for what you feel comfortable with. If you're comfortable with the S&P or other ETFs, I recommend sticking with that and see how that goes, and then expand your horizons once you feel ready to do so. Now, the last 5%, I want to talk about growth stocks. And now, what is a growth stock? A growth stock is any share in a company that is anticipated to grow at a rate significantly above the average growth of the market. Now, these are stocks. These are usually single stocks, for instance, Tesla, NEO, Virgin Galactic. These are stocks that where you make these gains and where they're going to be growing rapidly. And I think these are really interesting and exciting stocks, because although the risk is quite high, so is the reward. And we've seen with Tesla, it had been very volatile, and it still is tremendously volatile to this day, and it probably will be for the next 5 years, as it's traded heavily. But you also have the returns, and the people that have been investing in it for a very long period of time, who have believed in it, they've had very huge returns. And the growth stocks that I would recommend paying attention to are the stocks, for instance. Find that industry. I like the EV industry, the electric vehicle industry, and the renewable industry, and also space tourism. And these are the industries that I'm going to try and specialize with in the next 5 years, so I can make really informed decisions in these industries to that hopefully pay off greatly in my favor. But yeah, these are just an idea of industries that I think that companies and growth stocks in these industries can really thrive in. So yeah, this is just an idea, just to give you an idea of how to invest your first £1,000. Now, just to recap, I say 70 to 80% in an ETF, 10 to 15% in a REIT or an REIT, a real estate investment trust, or you can invest that in another type of ETF just to spread it about. And then the last one is the growth stocks, where you can have that small portion of money that can give you some sort of return, but if you lost it, it wouldn't exactly impact you massively. Now, just remember, don't play on your emotion, and this is for entertainment purposes only. And all decisions, I urge you to do your own research to make the best educational decision just for you. Now, if you're comfortable with your risk and your very high risk tolerance, you can go into growth stocks. But just remember that with that great risk comes a great reward as well, and vice versa. And you shouldn't, just because that stock shoots up 30% within a month, for instance, it doesn't make you 30% smarter, as Jeff Bezos has said, or if it goes down 30%, does that make you 30% dumber? No, it doesn't. So just remember, just don't play on your emotions, and just if you are going to go do a growth stock, just keep an eye on the company, understand where the management teams come from, and their vision. And if that vision you can see being in high demand within the next 5 to 10 years. Thank you very much for watching my video. I hope you really enjoyed it and found it informative, and I'd like to listen to your comments below about any stocks that you'd like me to discuss or review earlier, or review next time. Cheers. Thank you very much, guys. Bye bye.